All right, so learning objective 2 in chapter 6 is really where the work is. And that's because, as I mentioned to you, once you go, well, you understand from our talk about inventory in chapter 5 that companies are always buying new inventory to stock the shelves. Um, and at some point in time, the cost of that inventory is going to change for the company. And that's going to affect their cost of goods sold. It's also going to affect their inventory value, but it's going to affect their cost of goods sold. So you walk into a company, and let's say you walk into some type of retail, so like maybe H&M, and you buy a really nice jacket. Well, you know that jacket costs the company a certain amount of money, and then they have to sell it to you. So the cost that to them is going to be the cost of goods sold. But they might have many, many different types of jackets. They might have spent a lot of different money on jackets. So what do they actually cost out for each jacket? Well, that's the method that we're going to be looking at. They have a choice to use different methods to cost out their inventory. The most popular methods are listed in the bottom here. Okay. The first method is called first in, first out, which means, or FIFO, which is actually a great name for an accountant's dog. Dear FIFO. And so it's really talking about the first inventory, the first piece of inventory in the store is the first they cost out as cost of goods sold. So FIFO, first in, first out, really talks about the flow of the inventory. Okay. The first ones in the store are the first ones they sell to the customer, at least from the accounting standpoint. Okay, we don't actually physically know whether that's actually the very first one they bought and sold to the customer. But from an accounting standpoint, we have to cost those things out. So this is a method in which we can use. Okay, the first one in is the first one out. Another method that's available for companies is called LIFO, which of course is what a lot of accountants tell their kids. Would you please get a LIFO? Okay. And in this case, they look at it the opposite. The last inventory that came in the store, because remember, companies are buying inventory all the time. Trying to just buy it once and it sits on the shelf and that's it. It's sold, they're going to replace it. It's sold, they're going to replace it. So there's a constant purchasing of inventory that goes on through the year. Well, in a LIFO method, they look at the last one that's in. The last piece of inventory that came in is the first one that they used to cost out. That becomes the cost of goods sold. And you'll see how this works very shortly. And the last method companies can use is something called average cost. So that's just basically, this is all the money we spent on inventory. This is all the number of units of inventory we have. This is the average cost of the inventory. And they simply use that number. So we're going to be looking at those three methods. And again, the purpose of these methods is once we sell our inventory, we must have a cost of goods sold for the inventory. So we can use any of the three cost flow methods to show how we are costing out our inventory. Okay. So let's go here. So the first thing you don't have to know is specific identification, which is, it is a legitimate method that's being used, but it is not something that's common, and we don't cover it here. You will get it in an intermediate accounting class and beyond, but here it's not really necessary. So what type of cost flow assumptions do companies, merchandising companies, use? Well, the winner is clear. The winner is FIFO. Almost half of the companies out there use the FIFO method. The first inventory in is the first inventory they cost out as cost of goods sold. As you see, LIFO comes in a distant second. About a quarter of all companies use the LIFO system. The last inventory coming in the store is the first inventory they cost out. Average cost and the other come in, fill in the remaining gap there. Okay. So let's take a look at how it works. You cannot do any of this stuff without looking at the inventory. Okay. You can't do any of it without looking at inventory. So this company is called Houston Electronics. And the product that they're talking about here is something called an astro condenser. Okay. They happen to use the calendar year as their fiscal year. So at the beginning of their fiscal year, they looked and they had inventory of 100 units that were in the store. So they already had 100 units in the store to begin their year. They paid $10 each for those units. That's their cost. That's not what they sold it to the customer for. That's their cost. So the value of inventory in the store at the beginning of the year was $1,000. That's literally how much inventory they had in the store at the beginning of the year, $1,000 worth. And again, that comes from the number of units that they had and the cost. So, as you know, businesses cannot just live on their beginning inventory because it's never enough. So they make purchases throughout the year. And so here, this company made 3 different purchases. The very first purchase they made was in April. They bought 200 more of these products, astro condensers. But as you see, the cost to them increased from $10 to $11. So instead of paying $10 each, which is what they actually paid for the 100 that was already in the store, they went in April to purchase 200 more, and the cost had increased to 11. So that meant that that particular inventory from April cost $2,200. But as you see, after April, they had $3,200 worth of inventory in the store and 300 units of inventory after April. When you look at it just up to April, that's what's in the store. Okay, that's what's in the store. Oops, as of April, what did I just do? Okay, it's recording me, which is always very, very sad. Okay. So now let's move on. At the toward the end of August, they went and bought more of these astro condensers. They bought 300 units of astro condensers. But look what happened. Their cost increased. So when they purchased those astro condensers to put in their store, now they're paying $12 each for these astro condensers. $3,600 more of inventory was purchased. As you see here, this is their total inventory at the end of October, these 3 numbers and the 600 units here. And the cost here was $4,800. Okay, all of these. So this is the total, a running total in your head, the total available for sale by the end of August. And as you see, at the end of November, they bought 400 more of these units. And again, it cost them yet more money. Their cost increased to $13 a piece. So now they forked out another $5,200 for these 400 units of inventory. Okay, so throughout the year, they had 1,000 units available for sale. That's the total units available for sale was 1,000. And the total cost for those units were $12,000. Okay, does everyone understand? Don't read too far ahead. We're just going line by line. That's the only way to read these things, line by line. Okay. So if you have any questions, please pop in at any time. All right, so that's the total. 1,000 units that cost the company $12,000. That's just for this product, this Astro.
One quick question.
Yes.
And so this is regardless of what's being purchased at the
Yes.
store then?
Yes.
Okay.
Hmm. For our purposes here, yes. There actually is a way to do it continuously, which is done in reality. But from a textbook perspective, we're trying to explain what you've learned already and demonstrate it. So yes, in the sake for our sake here, we're going to be looking at it as a total. So this is the total amount of units for sale, which is reasonable because you have beginning inventory of 100 and you have all your purchases. You purchased 900. So the total is 1,000. Total is 1,000. Those are the number of units. You paid $12,000 for these 1,000 units. And again, only two things can happen to these Astro condensers once Houston Electronics has purchased them through the year. They either still own them, and if not, we assume the units that are not there have been sold. So if you notice here, at the end of the period, they still own 450 of the 1,000, which means that they sold the other piece. Again, the good thing what happens with inventory is it can only be broken into two pieces, this total. The part of it that you still have in the store, that's your ending inventory. And if it's not in the store, we assumed it's been sold. Okay. So this is that little chart in chapter 5 that we learned about the flow. Beginning inventory plus purchases, that's your total. That's this number right here, total available for sale. We take away the ending inventory, which is still your asset. You still own it, still on the shelf. And what's not there, we're going to use as cost of goods sold. Okay. So that's very, very important. So to follow up on your question, right? One of the questions that's asked is, okay, well, what if someone came? Let's say they sell these Astro condensers for $30 a piece. Okay, and you walk in and you purchased one of these Astro condensers for $30. All right, the $30 is their revenue. We're not talking about revenue here. But as you know, the very first thing they have to do is subtract cost of goods sold. And this is where the cost flow assumptions come in. Okay. They can say using FIFO that the first ones in were the first ones that were sold. So you came in and bought an Astro condenser. Under FIFO, you bought one of these units because these are the first ones in the inventory list. So the cost of goods sold would be $10 until, of course, all these units are gone, in which case you would use the $11 until all those units are gone, in which case you would use the $12. So in terms of FIFO, you're looking from the top of the list down. Okay. The top is the cost of goods sold until all these units are done. Okay. So if they sold 101 units, all these 100 units are gone at $10, and one of these is going to be costed out at $11. So that's how they're going to look at FIFO. Okay. Of course, LIFO is just the opposite. It's bottom up. But we'll get to that. Let's keep with FIFO. So again, the first ones in on that list, you have to look at a list. Otherwise, this makes no difference. This makes no sense whatsoever. Okay. So you look at that inventory list. Which ones are the first ones in? Under FIFO, they're the first ones that we use for cost of goods sold. Okay. That's the simple way of looking at FIFO. The first ones on that list is the first ones we use for cost of goods sold. Okay. So it literally follows the physical flow of the merchandise. Okay. And so that's what you're going to look at here. So of course, like anything in math, there's a few ways in which you can figure this out. Your book gives looks at it from a periodic perspective. You take the total amount of inventory that you have. So that's the total amount of goods available for sale, which, as you know, is 1,000 units, and you spent $12,000 for all those units. The first thing they do is subtract out ending inventory. Well, under the FIFO system, again, the first ones in are the first ones out. And if you remember, let me go back. If you remember, ending inventory was 450 units. That's still in the store. So how they look at it is, okay, so under FIFO, all these units at the very beginning were sold. The 450 that are still in the store are these 400 units, and 50 of these units are still in the store because the others have been sold at 12. And so that's what they do here for step one. What's still in the store? 450 units. Which 450 units? Well, all the ones from the top have been sold. So for what's left, 400 at $13, that's what's left. And 50 more, because we have 450 at $12 is what's left. So they say $5,800 of the $12,000 is still in the store. The difference is the cost of goods sold. Now, of course, in math, you can prove that number. You can prove that number, right? So how accurate is the $6,200? Well, you know that 550 units were sold. 550 units were sold. Which ones were sold? Well, the first ones in were sold. So of the 550, these 100 have been sold. They're part of that 550. These 200 have been sold. They're part of that 550. So we've accounted for 300 of the 550. The other 250 come from here. So basically, the August purchase is divided in two. 250 that are part of the ones that have been sold. The other 50 are still in the store. And if you add that up, you will also get $6,200 for the total cost. Okay, 1,000 plus 2,200 plus, I think it's another 3,000 or so. But anyway, and I'm doing it from a bad vantage point here. I don't have my calculator handy. Here we go. Let me just get the calculator out. Yeah, 3,000. Woohoo! Hey, good guess. I might play the lottery today. So again, you can always prove that number. But does everyone understand that the cost of goods sold comes from the top of the list, and the ending inventory in this case is what's left over after you take all those away? So this is how your book explains it. Total, subtract out what you still have. Again, you have $12,000 of inventory at the end of the period. You still have 5,800 of the 12. The rest gone. Cost of goods sold. How are we feeling on that? Let me just put the cameras on. How are we feeling about that? And again, it's a couple of ways, because it's mathematical, there's a couple of ways to look at it, right? You can actually calculate cost of goods sold first, and then what's left is ending inventory, or the book does it the opposite. They calculate ending inventory first, what's left over or what's not there is cost of goods sold. You're only breaking this into two parts. That total is only going to be broken into two parts: what you still own and what's not there. So that's how the FIFO system works. Looking at the list, first ones on the list. First ones on the list are the first ones sold. So if you know how many that were sold in total, well, then that's part of that. That's part of that. And 250 of those are part of that sold, cost of goods sold, which shows up down here. All the rest, the 50 that are left here and the 400, inventory. That's why they're here. This is a beautiful little illustration. I actually have this hanging up in my guest room. As you see here, this is all $12,000 worth of inventory, right? Broken into beginning inventory, that purchase from April, that purchase from August, and the purchase in November. As you see, the first ones in are the first ones out. So this amount of the inventory have $6,200 worth, the first ones in, have been sold. So that's why they're part of cost of goods sold. The ones that are still in the store, right, are all of the 400 units from the end of the year, November's purchase, and 50 units are left over from the August purchase. Their value is $600 because 50 times 12, 600 bucks. And that's still ending inventory. Again, this is our asset. It'll be a current asset when we're all said and done. Cost of goods sold, as you know, is an expense. Okay. So this is a beautiful illustration that I just ruined with my stupid handwriting here. Okay. LIFO is just the opposite. You're looking at the same exact list of inventory. And you're saying, look, the last ones on that list are the ones we sold first. So they're the ones that we're going to cost first. Okay. So the very latest goods that have come in is the basis for cost of goods sold. Okay. And so this is important. Again, it's the exact same list. We're always starting from the same list. If you don't have a list like this in front of you, you can't do these methods. So it all starts from the list. And the list is going to look the same. There's a total amount of units purchased over a period of time, blah, 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 right? With the total amount of value for the inventory, which is can only be done, it can only be broken into two parts. The part that you still own and the part that's not there is assumed to be sold, which is why it's part of cost of goods sold. So under the LIFO system, the last ones in are the first ones out. And again, we still sold 550. That's still the basis on which we have it. So which 550 did we sell if we use LIFO? Well, bottom up here. Okay, don't start drinking when I say that, but it's bottoms up. So these 400 are part of the 550. So these have been sold. They're part of the 550. So what's left? You need 150 more to reach 550. Well, you're going to break this into two parts. The 150 that has been sold off is going to be part of this 550. The 150 that you have here is going to still be in the store as inventory. Here are the costs that are involved. So again, the way I learned it, the opposite of what your book presents, but it's not, it's again, there's a few ways to do math, as everyone knows, right? So your book says, first of all, figure out what's left and subtract it from the total. So here's your total of 12,000. What's still in the store? Well, 450 units are still in the store. Which ones? Well, if you've already sold the ones on the bottom, the ones on the top are still in the store. So this 100 units is still in the store. That's why it's listed here. These 200 units are still in the store, which is why they're listed here at 11 bucks. Again, the cost is important. And as I was telling you, 150 of the August purchase is still in the store, and they cost 12,000. So you simply add the total up. So basically, of the $12,000 of inventory that you started with, the total, you still have $5,000 left that you own in ending inventory. The difference you sold. So that becomes your cost of goods sold. Again, you can verify this $7,000 number. How do you know what you sold? 550. Well, these 400 units at $13 were sold. So part of your cost of goods sold is the $5,200. And half of this has been sold, which is $1,800. 1,800 plus 5,200 is your 7,000. So you can check it. Either way, this number is only broken into two. What you still got in the store, you own it, it's an asset. What's not there, you're going to cost out. The LIFO tells you how we calculate that. So LIFO, the bottom last one in, is part of your cost of goods sold, which means the ones at the very top are still in the store, which means you still own them. Here's another wonderful illustration that your book has, and I do have this one in my hallway. And so it's a very beautiful painting, by the way. Just want to let you know. And again, here's your beginning inventory. Here's the April purchase, the August purchase, November purchase. This is your total. How LIFO, how we do LIFO is the last ones in. And as we talked about, all of the 400 units from August and from November, and half of the August units have been sold, cost of goods sold. The other part of the August, so the other half of August, all of the April and all the beginning inventory are still part of your inventory. It's just broken in two. Average cost is actually the easier one to use. It's simply a weighted average of everything. And so it makes it quite easy to figure out. For the average, you need the totals. You spent $12,000 total on 1,000 units. So each unit costs 12 bucks. That's your average cost of every unit. So the total cost here divided by the total number of units that you bought with it. That's the average cost. And so once you know you still have 450 in the store, you know they're worth 12 bucks each. So you have $5,400 of inventory still with you. You started with 12,000. You still have 5,400. The rest have been sold. How can you verify the cost of goods sold with average cost? Well, you sold 550 times 12. And that would provide you with that. Here's a beautiful illustration. Here, I actually have this in my bedroom. And so here what you have is the total amount of money you spent on the inventory divided by the total amount of units you bought with that. So that gives you the average cost per unit. You know you have a certain amount of units left in ending inventory. You multiply it by the average cost of 12 bucks. You know you sold so much. That's your cost of goods sold. What does it matter? Why should companies use one or the others? Again, companies have a choice. They actually can use any of these three, including specific IDs or any of the four. But for retail, it's going to be these three. As I was showing you earlier, FIFO has been the clear winner. In terms of like about half of the merchandising companies in that survey used FIFO. LIFO was a close second. Average cost was a distant third. So what really kind of determines what you should use? For my rule, in general, you want to use the method that gives you the highest gross profit. Because remember from chapter 5, we looked at the gross profit margin rate and we looked at the net profit margin rate. Those matter. Those are financial statistics that matter to analysts. And so you want that gross profit margin to be to look good, look really high. And for Houston Electronics, based on the information we have, the FIFO method would be the best method for them to use because it produces the highest gross profit. Conversely, it also produces, in this case, the highest net income. Okay. Using LIFO would not be ideal. Using average cost would not be ideal because it would affect their gross profit margins. It would also affect their net profit margins. So again, that's that would be the thing that you would look at. If companies were worried about taxes, well, then in this case, you don't want to have a very high amount of income or profit, so you can reduce your tax. But if I'm a stockholder, I'm not happy with this. I'm happy with that. So oftentimes it doesn't really matter to a lot of companies what the end result is for their taxes. It really matters to owners that their company is profitable. Okay, so let's take a look at their DoIt exercise number 2 for today. It's cost flow methods review. And here we have the accounting records of Shumway Agricultural Implement. Okay. And they have the following data. They have beginning inventory, 4,000 units at $3. That's a cost. Looks like they bought 6,000 more units at $4. That's their cost. I want to caution you on how to read this. All right. Sales, we don't really, we're not calculating revenue. So we really don't care what their sale price is. What we care about is how many of these units did they sell? Because that's the number we need to solve the issue. So again, it's the total amount. It's the total amount that they have for. That's really important here. So here we know we have 10,000 units. 10,000 units. The beginning inventory is $12,000. 4,000 units at $3, 12,000. Okay, so we have $12,000 of inventory to start with. 6,000 units at $4 is 24,000. Okay, the K I'm using for 1,000. Okay, so they have a total of 10,000 units. Right, because again, just like chapter 5 was teaching you, beginning inventory plus purchases gives you the total. All right, gives you the total available for sale, and that's what we care about. What's the total available for sale here? 10,000 units are available for sale. How much did they sell? 7,000 units of those. Right, 7,000 units of those. So that's how you need to look at all of these. Okay, that's how you need to look at all of these. And remember, as the name reminds you, there must be some way of figuring this stuff out. No, not even a smile. There must be some way of figuring it out. Get it? Okay, thank you very much. Comedy's over for today. So if we use FIFO, what 7,000 units did they sell? What 7,000 units are still, what are the units that are left? So if they use FIFO, again, the first ones in are the first ones out. If they sold 7,000 units, all of these 4,000 units have been sold. It's part of that 7. And half of these units, 3,000, are part of that 7. Right. Or as your book likes to figure it out, 4,000 units at 3 plus 3,000 units at 4. So the cost of goods sold, and there's 2 things that your book can ask you. What's the cost of goods sold is one of them. The other is what's your ending inventory? Because again, the total can only be broken into 2 pieces, ending inventory and cost of goods sold. Here they're asking you for cost of goods sold, but they could easily ask you for inventory. So just remember to read what they're asking you. So in this case, for FIFO, the cost of goods sold under this for Shumway would have been 24,000 under FIFO. What about LIFO? Well, LIFO is just the opposite. The last one's in. The last ones that were purchased are the first ones that were sold. So this 6,000, all of these 6,000 units are part of that sale. And we need 1 more 1,000 from here to finish our 7. So that means that our cost of goods sold under LIFO are the 6,000 units at $4 plus the 1,000 more units at $3. So our cost of goods sold here would have been $27,000 if we use LIFO. Well, what if we used average cost? Average cost, well, we would have needed to figure out, first of all, the total number of units that we have, which you know is 10,000, right? And the total amount of money we spent on that, which is 36,000. So $36,000 divided by 10,000 units will give you an average cost of $3.60 for every unit. Okay. And they sold 7,000 of them. So $3.60 is the average cost for each unit. And they sold 7,000 of them. And so that would give you $25,200. Okay. Or as your book puts it, this is the total amount of inventory minus the inventory. It shouldn't be dollars, should be 3,000 minus the inventory they already have in leftover, which is 3,000 units at 360, would give you the difference, which is your cost of goods sold. So this is going to be the challenge for you. This is where the work is in this chapter, but it's not a ton of work. It's just, again, if you have that list in front of you, that's the key, because you're simply reading the list, right? And don't forget, from the total amount of inventory, that total amount, only 2 things can happen. Either it's still with you, which is your ending inventory. If it's not there, cost of goods sold. How is that figured out in terms of the actual numbers? You can use FIFO to figure it out. You can use LIFO to figure it out. Or you can use average cost to figure it out. Companies have the choice. Okay. So a lot of companies, like they say, would use FIFO because every time they buy new stuff, it seems though their cost is increasing. And so FIFO makes a lot of sense for a lot of companies, as you saw. But can you think of any products that over time get cheaper? So they might start pretty expensive, but over time it actually goes down.
I mean, I suppose seasonal stuff like Christmas stuff.
No, I don't think that would be an ideal thing. Dennis, what would you say? Clothes actually would probably increase over time. I can't hear you. You're muffled again. Electronics. So, when the newest phones or newest computers or newest televisions come out, they're really very high priced. They cost the most for the business to sell. But over time, of course, everything goes down. All right. Um, and so if I were an electronics store like a Best Buy, um, I would go ahead and probably look at it and say LIFO actually probably is better for me to use, because with the LIFO system, um, I'm actually getting a higher gross profit. You know. So it really sort of depends. I don't know about automobiles. I really don't know. I don't know the answer to that, but we can look it up. We can look it up. Um, you can read in any of the annual reports what type of inventory system they use. So I think that in general, this is what um, businesses have to choose from. And again, they can choose anyone that works for them, okay, depending on their particular situation. Yes, Brandon?
And uh, so it looks like, yeah, whether you're uh, backing in the information or starting from the beginning, there's a variance of cost. But if you were to just, and I know you were talking, there was another method. If you were to just scan all the SKUs that were sold, you'd be able to drill down to an exact number. So there's some amount that's almost like left up to the method that might not actually exist per se, given the placement of those items that are being sold. Like you sold 50 early in the month, but you decided to do the LIFO for, whatever reason. Because
Well, so first of all, you have to once you select, once a business can't flip. So once a business selects a method, that's their method. That's how they're going to do their accounting. Remember, under generally accepted accounting principles, you're not allowed to sort of just pick and choose at random. You have to select a method that works for you, because again, this method is going to impact your income statement and your balance sheet radically.
uh-huh.
So if it's going to affect your financial statements, you have to stick with the same process year to year to year. Only if your business significantly changes is there an opportunity to change methods, but you have to sort of prove it. You
Mm.
just can't decide to do it. So, and a lot of these businesses have been, existing for a long time, and so most retailers use a FIFO method. Um, it's very, very common for them to do so. And so, that's their method. Unless their business dramatically shifts and they're no longer the same type of company, they're actually morphed into a different company, that they can actually prove that they should change to another method. Otherwise, they just don't have that type of flexibility. And you'll see in the next part of the chapter what happens to that inventory over time that is not sold and thus has changed in value. Um, you'll see how we handle that in objective 3. Okay. So that's enough work for you for 2 days. The homework has been released and it's available for the 2-day period. When I see you on Wednesday morning, we only have that little piece of chapter 6 to do, which is super. I think it's easy. Um, and then I'm actually going to be releasing not just the remaining homework, which is just one more homework for chapter 6, but I'm also going to be releasing the exam for 5 and 6 throughout the weekend till next Monday. Okay. So we're going along. Questions?